December, okay, the last day of trading in 2005, I believe, was December 30th. Okay, so this is giving, you can see it has all these down here for the, I'm going to go down to the last one and see what I've got. Okay, here's the closing price, December 30th, 2005, the last day of trading. So that's the one, the first one you need to get. And then, and you know, some of you, if you're doing foreign stocks that don't trade on the markets here in the United States, you might have a different beginning. You need to get the last day of trading for 2005 because they may have different holidays in other countries. Okay, so this got, so I know I've got it back to December 30th, 2005. Now what I'm going to do is download that. Just click on this. Okay, what it's giving me is this file. It's a CSV, comma separated values, which is something that Excel can read. It's not an Excel spreadsheet, but it can read it. Okay, now I'm going to go ahead and save this as an Excel workbook. I'm going to save it to my flash drive. Okay, this will be U.S. Steel historical prices. Okay, now all that I need is the closing prices for each day. So I'm going to go ahead and delete open, high, and low. And I'm going to delete volume. Okay, the next, okay, you can see I've got this. This is as of the close of trade yesterday, and here is as of the close of trade the last day in 2005. So I've got 2,713 days there. And now what I'm going to do is I'm only going to do it, so I'll have a round figure. I'm only going to do it through 2015. I'm going to go ahead and delete this stuff for 2016. It's not something you would normally do if you're researching a stock, but for our purposes, just to get everything on the same time frame, I'm going to go ahead and do that. Okay, so I've got that through the end of 2015. All right. So what is it asking me? This says for the last 10 years, compute the stock's arithmetic holding period return for the entire 10 years. Okay, what I'm going to do is I'm going to ignore dividends. And that is normally something you would not do, but I'm going to do it for this case. Some of the sources you will find will include dividends or give you the dividends and the date, and some of them will not. You know, it depends what you do with the dividends. If you take the cash or if you reinvest them or whatever. Well, I'm going to go ahead and ignore dividends, and that's not completely realistic, but it's not very important for the kind of stuff we're going to do. We are more concerned for this class, not so much with the expected return stuff, but more with the, you know, the volatility and the covariance and the beta and the CAPM and that kind of thing. So I'm going to go ahead and leave dividends out of it, because what I've found is like, you know, we talked about how dividends are smooth, especially smooth compared with stock prices, which tend to jump up and down all over the place. So it doesn't make that big a difference as far as the movements of the value of your investment position are concerned. All it's going to do, it's going to add on to your return over some period of time. Okay, so I'm just going to go ahead and ignore dividends. And first thing it says, arithmetic holding period return for the entire 10 years. Okay, so I'm going to go arithmetic holding period return. This will be from 2006 through 2015. Okay, and what I want here.
I thought it was 2005.
Uh-huh.
Was it not 2005?
Yeah.
Okay.
Yeah, although I'm just starting with that last day in 2005. So it's looking over that 10-year period, 2006, 2015. I have to start with the close of trading the last day of 2005. So all I got to do here, guys, this is going to be B2 closing price on December 31st, 2015, minus, and I would go over here, go down to here, this will be B2519, the close of trading at the end of 2005. Okay, so that gives me the difference right there, and then I need to divide that by B2519. Okay, so put that into percentage. That's going to give me 83.4% negative return. I hope we didn't have any splits that time. I don't think U.S. Steel has split in a long time, but I may be wrong. Okay. Next thing it asks for you to do, annual arithmetic returns for each of the 10 years. Okay, so what I got to do here, let's do it for 2006. Okay, first thing I know is the beginning price would be B2519. Now I need to find the year-end price for 2006. Oops. Okay, here it is right here, B2268. So this is going to be equal to B2268 minus B2519 divided by B2519. Okay, so for 2006, it had a 52.15% increase. Then we can do it for 2007. I'm not going to do it for every year, I'll just show you. Okay, for 2007, okay, last day of trading 2007, B2017. It's going to be equal to B2017 minus, what was it, 2268 divided by B. Okay, so for 2007, positive 65%. That's 20, yeah, okay. And you keep doing that through 2015. I'm not going to go through all those. I'll just show you an example there. Okay, and then ask you to compute annual continually compounded returns for each of the 10 years. And you'll see why I like to do this way. Okay, so annual, this will be continually compounded returns. Okay, for 2006, okay, the beginning price be $25.19, the ending price be $22.68. So all you have to do equals ln for natural logarithm b $22.68 divided by b $25.19. So that gives me, see, that's the price at the end. That $25.19 is the price at the end of 2005. B $22.68 is the price at the end of 2006. Just take the ratio, take the natural logarithm. So that's giving me 41.97. And you'll notice it's less than the arithmetic holding period return. That continually compounded is always going to be less than the arithmetic. Okay, we'll do it for 2007. Here we need 22.68 in 2017. B 2017 divided by B 2068. Okay, so there's continually compounded for 2007. Okay, so now what it's asking for is for you to draw a chart, put them both on the same chart of these annual averages, and what you'll do is you'll just put the year on the horizontal axis. So you'll have 2006, 2007, blah, 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 up to 2015. And this will be returned. And you'll have, let's see, you'll have your arithmetic 52, continually compounded 42. So this will be like 52, 42. And then these will be 65 and 50. So this will be up here like this. This will be about like this. So you'll have, I don't know what it'll look like. It'll be different for every stock. You just connect the points, get it to draw a line. And so you'll be sure to label it. You can do it like in the legend, or you can just put some kind of label up here on the graph. This is going to be arithmetic returns, and these will be continuously compounded. Okay. Okay, next thing would be volatility. You want to compute the standard deviation of the stock's return over the entire 10-year period, and you want to get it from the daily continuously compounded returns. So the first thing we need to do is compute the daily. I'm going to insert the rows here. daily equals okay. So that gives me, this is the daily continuously compounded return from December 30th to December 31st. So I just take the second day price divided by the first day's price and take the natural log of that. Okay, and then I'm going to just got to copy that all the way down. And stop right there. All right, so I got it for every day. Now what I'm going to do, okay, I've got these. These are the daily returns. I'm going to go ahead and convert that from a formula to a value, and you'll see why in a minute. Copy, paste special values in number format. So now I've just got the numbers there. Okay. Okay, now what we want to do is compute the standard deviation.
Can you go back to that daily return? Sorry.
Yeah.
It's just ln of.
ln, yeah. It's just the natural log ln of the price on December 31st, 2015 divided by the price on December 30th, 2015. Whatever those spreadsheet references are. Yeah.
And when you pasted it, go back to like the special, or did you go to values?
Yeah. Yeah. See, here's what you do. If you want to, okay, let's say, see here I've got this annual return for 2007. It's showing a formula there. Okay. If I want that number there instead of the formula, all I gotta do is go right click, copy, and then don't move the cursor. Paste special. I usually go values and number formats. I don't think there's anything special about that number format. I'd probably do just the same if I just hit values, but I just out of habit I hit values and number formats. Okay, and so you can see now what it's got. Instead of the formula in there, it's got the number that it computed in there. That's really handy.
How far should we round these numbers to? Just hundredths place?
Yeah, I do like hundredths of a percent. Yeah, that's. Okay, any other questions on that? Okay. Okay, so you're going to do the standard deviation for the entire 10-year period. Okay, this will be, let me see here. Okay, this will be, I'll title these Volatility. Standard deviation. This will be from 2006 2015. Now I've had y'all compute it using the formula before, but this would get rather tedious if you did it for everything here. So you can go ahead and use the Excel function for standard deviation. There are actually several in Excel. The one I use is this one, equals stdev.p. Okay, and then you just put in the range of numbers that you want to do it for. And this is going to go from C3 down to C 2519. I'll have to double check that. Yeah, 2519. Okay, so that gives me standard deviation, daily standard deviation over that entire period. Okay, so next thing it wants, compute the annual standard deviation of the returns computed from the daily continuously compounded returns for each year. So you want to do it for 2006, 2007, and so forth. Okay, so 2006 was, that's from 2519, I think, to 2269. Yeah, 2519 through 2269 equals STDEVP C 2519 C 2269. Okay, so you can see, you can already tell something about that, is that during 2006, the volatility of U.S. Steel stock was less than it, and the daily volatility averaged less than it did during that whole 10-year period. Okay, so let's do it for 2007. For this one, we'll need 2269, I think 2268 probably. 2268. Okay, yeah, we'll do it for 2268 through the end of the year 2007. Okay, so I'm going to go back up here. 2007 equals STDEV.P B 2268 B 2018. Okay, so it got a lot more volatile.
Would you use B or C on that?
Oh, thank you. No. Yeah. It didn't get more volatile. I suspect, here, I want to go ahead and do it for 2008 while we're at it, because I suspect it did get a lot more volatile by then. STDEV.P. That's gonna be C 1765, C 2017. Yeah, got a lot more. Probably wasn't as much as the oil companies were, though. But you can imagine, you know, the energy prices fluctuated wildly during that year. Oil went up to $150 a barrel, and then by the end of the year it dropped down to 50. And natural gas at one point went up to 14. And since then it's been down. It's only like $3 per million BTUs now. Okay, so that's, you just do the same thing for, you know, get the daily volatility for each year from 2006 through 2015. And then next thing you graph the annual standard deviations. Just do it the same way you did with that, except you only have one line for that. Okay, any questions on any of that so far? Okay, next thing, value at risk. Okay, remember, value at risk is an important concept when you don't have normally distributed returns on a stock. And in fact, I dare say on stock you never have normally distributed returns. Remember what I told y'all about the distribution of a stock's return. Okay, let's say this is a normal distribution. This goes out to negative infinity. Okay, let's say the mean is whatever. Let's say the mean is positive 10%, and then here's 0, and here's negative 10%. That tail never ends, and this one never ends on the right side. There's no reason to put an upper limit on the stock's return, but there's definitely a lower limit. Stock's return is biggest loss you can have is negative 100%. So by right there, you know it's not normally distributed. For some purposes, you can assume it's normally distributed, but it's not. But when you get into something like that, you know, some issue like that, you know, like if you're going to ask an investor, would you rather have an investment where the worst thing that can happen is you lose all your money you invested, or would you rather have an investment that not only you can lose everything you invested in it, but you can lose everything else, including your house and your diamond jewelry and your firstborn child and everything else, you know? So that's the big difference there. So the deal with value at risk. Value at risk is really useful when you don't have a normal distribution, which is, like I said, is always the case. Okay, let's say the distribution on some stock is like this. So let's say here's the mean right here, and it's 10%. And let's say the lower 5% returns in this distribution, let's say it goes out here, something like this, and this is negative 100%, so it stops there. Let's say the lower 5% are right here. The area of this shaded part is 5% of the whole area under that curve. So whatever this is right here, let's say this is I don't know, let's say this is negative 50%. So the 5% value at risk, remember I'm capitalizing that R to distinguish it from variance. 5% value at risk is negative 50% return. That shows you where that 5% starts. It goes down to, in this case, to negative 100%. So what I'm going to ask you to do is to compute the 5% value at risk and the 1% value at risk. The way you do it is actually quite easy. Okay, you've got all these returns here. First thing you need to do is to rank them from lowest to highest. What I'm going to do, I'm going to do this. I'm going to highlight all this. Down to here. I'm not going to include that one because I don't have a return for that one. Okay, then I'm going to go up here and do data sort. And I want to sort by this column here from lowest to highest. The daily continuously compounded return. So let's see, it's got Excel recognized the fact that I had already highlighted those that row number 2 there that has those labels on it. And so it picked those up. CC return. It's asking me, do I want to sort by that? And I say, yeah, I want to sort by value. I want to go from smallest to largest. So here's what I've got. These show me the rankings from the worst day that U.S. Steel had was October 15th, 2008. To the best day, December 8th, 2008, positive 21. So it ranges from negative 19 to positive 21. It's not surprising that that would happen in 2008 because that was the year of the highest volatility. Of course, steel is a very energy-intensive industry. So what, the price of oil, price of natural gas, is going to be very important to them. The price of coal is going to be very important to them.
So how do you sort that? How do you sort that again?
Oh, okay. Here's what I do. I highlight everything, including this